Silver just flashed a once-in-decades signal, and the next move could reward you or wreck you. In the past 52 years, this specific kind of monthly surge has shown up only twice. Until now, January 2026. What I am about to walk you through has appeared only 2 times in modern markets, and each time the aftermath was extreme, just in opposite directions. One path minted fortunes, the other turned late buyers into bag holders for years. Same trigger, 2 radically different endings. And today we're watching the third instance form in real time. Most people don't realize this is even a thing. Most commentary ignores it. Most investors are staring at the price and missing the pattern underneath. But by the end of this video, you'll understand what just printed on the chart, what happened the last 2 times it printed, and how to think about what might come next without getting pulled around by emotion. Here's the uncomfortable reality. The next 8 weeks may set the tone for the next several years in silver. Are you prepared for that? Welcome back to Vantage Economics, where we unpack messy market behavior with history, structure, and plain language. No theatrics, no magic predictions, just a framework you can use. And yes, there's a follow-up to this analysis you'll want, because the next phase of this move, if it continues, will demand different rules than the last phase. So what happened? Silver just delivered something rare. In January 2026, it rose about 65% in a single month. That sounds like an internet headline, but the rarity is the real story. Over the last 5 decades, silver has posted a 65% monthly jump only 2 times. Once in early 1974 and once at the end of 1979. That's it. 2 occurrences in 52 years, then a third one today. And zoom out 1 layer, silver is up roughly 270% over the last year. That isn't healthy trending, that's acceleration. That's what markets do when they start feeding on themselves. Let's define the behavior clearly, because your decisions depend on this. This is what traders call a parabolic phase. Price action stops stair-stepping and starts climbing like it forgot gravity exists. Pullbacks become shallow or disappear. Consolidations don't have time to form. Every dip gets absorbed quickly and the slope gets steeper. It feels unstoppable until it isn't. Why does this matter? Because parabolic phases are both wealth-making and wealth-destroying, depending on when you enter and how you manage risk. Here's the trap. The more thrilling it gets, the more dangerous it becomes. When a market runs like this, the reversal, if it comes, tends to be fast enough that "I'll react later" becomes a very expensive sentence. So we need history. We need to see what followed the last 2 times this exact type of month showed up. And then we need to translate those lessons into a plan for today. Sound fair? First, go back to late 1979. This era is one of the most studied moments in metals, and for good reason. Silver had already been rising for months, inflation was ugly, confidence in paper money was shaking, and a small number of giant players were pushing size into the market in a way that distorted the normal flow. In December 1979, silver printed a roughly 65% monthly gain, the same magnitude we just saw. People didn't just get optimistic, they got convinced. Media coverage heated up. Dinner table conversations turned into price targets. New buyers piled in because the chart looked like proof. Now you might be thinking, that was a totally different world. Different catalysts, different regulation, different big players. Sure, but markets don't repeat because the props are identical. They rhyme because the audience is human and human behavior is consistent. Greed doesn't need new technology to work. Fear doesn't require a new decade. So what happened after that 65% month? It didn't cool off right away. It ignited again. In January 1980, silver added another massive month, on the order of 35 to 40% on top of what had already happened. Then it peaked near $50 an ounce around January 21st, 1980. That date became a scar in market memory, and the decline that followed wasn't a gentle, healthy correction. It was the kind of fall that changes lives. It happened quickly. It punished leverage. It triggered forced selling. People who thought they were late but smart discovered what a liquid panic feels like. Fortunes evaporated faster than most could process. The collapse was so disruptive that rule changes hit the market. The big, concentrated players eventually got crushed. And here is the part many newer investors don't truly internalize. That roughly $50 peak remained the historical high watermark for about 45 years. Almost half a century with that level acting like a ceiling the market couldn't permanently escape. Yes, silver nearly matched it in 2011, close enough to tease everyone, but it didn't decisively clear the zone because that level wasn't just math, it was memory. It was a psychological boundary anchored to trauma. When a price level becomes a story, it takes longer to break. Only in this current run have we finally traded above that region in a meaningful way. So that's outcome A, the late 1979 blueprint. A rare 65% month, then one more explosive month, then a brutal unwind and a peak that haunted the chart for decades. Now bring that logic into January 2026. If our January resembles that December, Then the next chapter, if it rhymes, would be a second surge month. And if that happens, where could price land? Let's do simple math, not fantasy. Say silver is hovering around $110 after the recent chaos. A 35 to 40% follow through from there puts you in the neighborhood of 150 to 160. That is in T a prophecy. It's a scenario derived from the historical cadence. And at those levels, many indicators would be screaming. Momentum would be stretched, sentiment would be euphoric, and the loudest voices would start treating higher prices as guaranteed. That's typically when risk is highest. Not when fear is high, but when doubt disappears. Have you noticed how tops usually feel safest? If we do travel into that 150 to 160 area, that's the zone that deserves maximum caution. Not sell everything and disappear, but reduce exposure, respect volatility, and stop assuming the elevator only goes up. Because in parabolic markets, the exit door shrinks fast when the crowd turns around. Now, that's only one of the two historical outcomes. The second case study matters just as much because it leads to a completely different kind of pain. Go back to early 1974. The macro environment had similarities: inflation pressure, currency uncertainty, and a metals bid fueled by distrust in policy. In February 1974, silver also printed a roughly 65% monthly jump. Same trigger. And traders at the time expected the same thing everyone expects today: continuation. If it did that, surely it keeps doing that. But it didn't. Instead of another fireworks month, silver cooled into something far less dramatic but far more psychologically brutal. A long grinding range. Not a crash that ends quickly, more like boredom that lasts forever. For roughly 5 years, price chopped sideways, teasing rallies and rejecting them, draining attention and conviction. Imagine watching other assets run while your silver position becomes a patience test. How many people do you think held on through 5 years of near nothing? Most didn't. Many sold out of frustration. Some needed liquidity. Some decided they were wrong because the market stopped rewarding them daily. Media coverage disappeared because flat markets don't sell stories. Silver became uninteresting right up until the late 1970s, when it finally broke out and went vertical into the 1979-1980 blowoff we already discussed. So in that 1974 path, the reward was real. But it demanded endurance most humans lack. That's why this moment is so serious. We're staring at the same type of rare monthly behavior that appeared twice before. One time it led almost immediately into a climactic top. The other time it led into years of chop before the next major advance. Two roads, one signpost. So which road are we on now? And more importantly, how do you keep your decision-making from getting hijacked by the next headline candle? Here's my read. Clearly labeled as a probability, not certainty, the current velocity feels closer to the late 1979 rhythm than the 1974 cooling off. Participation feels hotter. The narrative temperature is higher. The swings are wider. And when a market starts whipping 10 to 15% in a day, it's usually not entering a quiet 5-year range. It's usually entering a phase where emotions get harvested. But I can be wrong. The market's favorite hobby is humiliating confident forecasts. So instead of pretending to know, let's build conditional plans. One practical level to watch is whether price can clear recent highs and hold above them. If silver pushes through the prior ceiling and builds acceptance, the odds increase that we could see that second surge scenario. And if momentum carries into the 140 to 160 region, that's where I'd personally think in terms of scaling out some profit, taking risk off, not nuking a long-term thesis. Why? Because when blow-off phases end, they end with speed. By the time your brain says, maybe I should sell, the market may already be down 20%. The seduction at the top is powerful. You feel smart. Everyone agrees with you. Your feed turns into confirmation. And selling feels like betrayal of your thesis, of your tribe, of your future. That's exactly why tops are effective traps. Late buyers in 1980 didn't think they were buying a historic peak. They thought they were catching the start of the real move. They were wrong, and the chart made them pay tuition for decades. Don't donate your gains to the next emotional wave. Euphoria is the most expensive form of confidence. Now we also need to talk downside, because risk management isn't pessimism, it's survival. What if we don't get the 1979 style follow-through? What if we correct hard, or we transition into a long consolidation? In the 1974 style outcome, the market eventually built a base much lower before the next breakout. Translating that idea into today's structure, a deep washout zone could be somewhere around $60 to $70. That would be the kind of area where long-term accumulation gets interesting again, if, and only if, the market actually offers it. I want to be careful with how I phrase this. I'm not promising a floor, and I'm not promising we revisit any specific number. But I will say this: expecting the market to calmly hand you old prices after a regime change is usually wishful thinking. Many people are anchored to what silver used to be. Markets don't care about your anchor. If you're building positions, the question isn't, can it go down? It's can I withstand the down without sabotaging myself? The market punishes impatience more than ignorance, because the psychological battle is the real battle. Right now, volatility is extreme. Days with massive up and down swings, violent drops followed by sharp recoveries, then another drop. That's not a glitch. That's what happens when leverage, late buying, profit-taking, and forced liquidations collide in a thin hallway. Big players sell into strength. Overconfident traders borrow too much. Stops get hit. Margin calls cascade. One liquidation triggers the next. And in the middle of it, retail gets tossed around like driftwood. Here's the common retail loop in this environment. Buy after a big green move because it feels confirmed. Then a red candle hits, panic takes over, and they sell the low. Then price bounces, they buy again because they won't miss it this time. Then it drops again. Repeat until capital or confidence is gone. That cycle is how money transfers from reactive hands to patient hands. If you don't bring a plan, you will become someone else's plan. So let's make this actionable with a few guidelines. Not financial advice, just a framework to think clearly. If you hold physical silver, your timeline is usually longer. You're not supposed to be staring at hourly candles. Physical tends to be about long-term purchasing power and optionality, not perfect entries. In both historical outcomes, the long view eventually mattered more than the week-to-week noise. If you're trading silver, this is the danger zone. Parabolic volatility can destroy accounts even if your long-term direction is right. If you can handle a sudden 30 to 40% drawdown without making a rash decision or getting forced out, reduce size, no candle is worth a blown account. If you're sitting on big gains and you're wondering how to protect them, consider that 140 to 160 area as a risk reduction window if price reaches it. Again, not a guarantee, but a zone where history suggests the market can get unstable. And if you're looking to enter fresh, chasing a vertical chart is rarely a good deal. Patience usually pays better than adrenaline. And if you currently have no position, start small if you must. Think in increments. Build exposure like you're climbing a ladder, not like you're leaping a canyon. Do you want to be right, or do you want to stay solvent? At this point, there are three types of viewers. Type 1 hears this, nods, then goes right back to refreshing the price every 5 minutes. They'll feel every candle in their chest. They'll buy when it's exciting and sell when it's scary. Eventually, they'll declare silver rigged, walk away, and miss the long arc. Type 2 gets overloaded, 2 historical paths, multiple levels, uncertainty, and they freeze. They won't act at all because they're waiting for certainty, and certainty never arrives on schedule. Type 3 uses this as a decision tree. If price does X, I do Y. If we spike into a mania zone, I de-risk. If we cool into a long range, I stop expecting daily dopamine. This type isn't smarter, they're just prepared. Which type are you going to be? Let's compress the key points. A roughly 65% monthly jump in silver has occurred only twice in the last 52 years, 1974 and 1979, until January 2026 delivered a third. After the 1979 instance, the market surged again and then collapsed into a historic peak that took decades to surpass. After the 1974 instance, the market drifted sideways for years before the next major breakout. If today rhymes with the 1979 cadence and we get another explosive month, the 140 to 160 region becomes the area where topping risk increases. If today rhymes more with 1974, we may be staring at a long consolidation, and deeper pullbacks, possibly toward 60 to 70, become the kind of zones long-term buyers watch. Now, one crucial reminder. Calling a top in a raging market is one of the hardest games on earth. Nobody can hand you a guaranteed peak number, not me, not the loudest analyst, not the biggest fund. Markets move when they move, and they don't ask permission. My goal isn't to tell you buy here, sell there. My goal is to give you the context most people never get, so you can make decisions with your brain turned on. Because the biggest players thrive on one thing, predictable emotion. They want the crowd euphoric at highs and terrified at lows. When you're anxious, you dump. When you're greedy, you chase. The cure is not intelligence, it's planning. Build rules before the next candle tries to rewrite your personality. If this breakdown helped, hit like, subscribe to Vantage Economics, and keep your notifications on, because the next video will cover what I am watching as confirmation signals if silver accelerates or if it begins to fail. And I want your perspective too. In your view, are we headed toward an early 1980 style blow-off or a mid-1970s style long pause? Leave your answer below. And if you want a companion episode applying the same historical lens to gold, comment gold next. I'll read the replies and prioritize it. Stay calm, stay structured, and don't outsource your decisions to a feeling. We're reliving through a rare chapter right now, and the way you respond may matter far more than the price itself.